Hello, I just want to talk a little bit today about something that a lot of contractors struggle with, and that is over-under billings. Over-under billings is often referred to as the WIP, which is really the work in progress schedule that you use to calculate your over-under billings. And this is just a revenue recognition model in which your costs are the driver for your revenue rather than the actual billings. To illustrate this, we're going to talk about a few different concepts. One of the first concepts that we're going to talk about is the percentage completion on your job. Percentage complete. Percentage of completion is a fairly simple calculation. It's equal to your actual cost divided by your estimated cost. The next thing I want to talk about is earned revenue. Earned revenue takes that percentage of completion and it multiplies it by your estimated revenue. Estimated revenue. Then your over-under billing for a particular job, over-under billing, takes your earned revenue, takes your billed to date revenue, and it subtracts your earned revenue. So let's go into these in a little bit more detail here. Again, I said that over-under billings is a method to use your cost to calculate your actual revenue rather than using what you've billed. Here you can see that my actual cost divided by my estimated cost is going to drive my percent complete. My percent complete then is going to be used with my estimated revenue, or how much I'm going to bill at the very end of my job, to calculate my earned revenue. My earned revenue is subtracted from what I've actually billed to date to find if I'm either over or under billed. So let's go through a couple examples here and see if we can calculate our over-under billings for two different jobs. So let's talk about Project A and Project B. Project A is a small bathroom remodel that I'm doing. Project B is a larger new home construction that I'm doing. Project A and Project B both have a set of data that I need to pull from my accounting system or from my job costing records. The first thing I need to know is my actual cost. Next, I need to know my total estimated cost. Then I need to know what is my estimated revenue, or what's my contract amount. How much am I going to bill at the end of the job when my job is completely done? So estimated revenue you have to find out for all your jobs. Finally, you have to know what is your total billing. Total billing, also known as billed to date. If you know these four pieces of information from your job costing system, you should be able to get your over-under billings even just in a spreadsheet. So let's talk about Project A first here. Project A, like I said, is a small remodel. My actual costs on this job was $10,000. My estimated costs, when I'm all done with the job, I will have spent $20,000. I'm intending to bill the owner $25,000, but so far I've only billed $13,000. Project B, the bigger job, I'm just getting started on. My actual cost, I have $50,000 in it. My estimated cost is $300,000. My estimated revenue is $350,000. And my total billing to date is only their down payment, which was $10,000. So let's go through all of those terms that we talked about back on the other slide here. Percent complete, earned revenue, and over-under billings, and calculate all of those things for these two jobs. So first of all, what is our percent complete for these two jobs? Percent complete. For Project A, our percent complete, if we go back and look at our formula, is actual cost divided by estimated cost. Actual cost is $10,000. We divide that by our estimated cost of $20,000, and our percent complete is 50%. Now on project B, our actual cost is $50,000. We divide that by our estimated cost of $300,000, and that comes to a little bit different number of 16.66 bar percent complete. Now that we know our percent complete, let's look at the next step in the process. Let's look at our earned revenue. How much have we earned based on that cost? If we've spent X number of dollars, how much revenue have we earned? Earned revenue. So let's switch over to our project A here. Project A, if we take our 50% and we multiply that, our 50% here, we multiply it by our estimated revenue of $25,000, which I got from up here, we are going to get $12,500 in revenue. Similarly, in project B, we're going to take our 16.66%, multiply it by our estimated revenue, $350,000, which is what we're going to bill for the house when it's completely done, and we're going to get our earned revenue of $58,333, which I will abbreviate to 58.3K. So now we have our earned revenue for both of these projects, which I am going to come up and put into our chart up here. Earned revenue. We had 12.5 for project 1, and we had 58.3 for project B. Project A, project 1, it's all the same thing in the end. Earned revenue. Now we're ready to get the last step done. Our last step, if we go back to the first slide, is what is our actual over-under billing? Our over-under billing here is equal to our billed to date minus our earned revenue. Here's our total billed to date, here's our earned revenue, so we should just be able to subtract the two and find our over-under billing. 13,000 minus 12.5 equals 0.5K. And 10,000 minus 58.3 leaves us with negative 48.3K. So what is this telling us? This is saying that on this job, on project A, we are $500 or 0.5K overbilled. We have billed ahead of our earned revenue, and that is typically a good thing. On this job, project B, we have billed less than what we've earned. In fact, $48,000 less than we've earned. That is typically a bad thing, although it does happen naturally in some projects, especially residential projects. So the final step in this process is to do this for all of your projects and add them all up. So the company overall is $47,833 under billed. So the last thing to do is to adjust your financial statements with a journal entry. You'll adjust an asset account, typically a 1,000 account, which is called costs in excess of billings. And you'll adjust a liability account, which is going to be a 2,000 account, which is called billings in excess of cost. And you'll also adjust your 4,000 account, which is your revenue account. So like with any journal entry, you'll have a debit and a credit balance that match. And in this case, if we switch over to our other slide here, we can see our costs in excess, which is our $48,000 here, and we can see our billings in excess, which is our here. Now don't get confused by those terms. Billings in excess just means we've billed for $500 more than we've earned. In this case, costs in excess means we've spent more money or we've earned more revenue than we've billed by $48,000. So let's switch back to our journal entry here, and we can put in our debit, increasing costs in excess by 48,333. Our billings in excess we can put in for $500, and since we need to make these two balance, we can put in the remainder in revenue by 47,833. Now we have a balanced transaction, and you'll notice that our revenue for this period has increased by 47,833. So that's it for over under billings and how you adjust your financial statement. If you have any questions, feel free to give me a call.